So in this video, I want to talk about the best mutual funds for professors and PhDs, and just in general, anybody. I think this is really good advice. So if you don't know me, I am Professor Dave Massock. I'm Associate Professor of Innovation Strategy and Entrepreneurship, and I create this whole reciprocity project to give back as much as I possibly can. This is Izzy, by the way. And so I actually want to talk about the best mutual fund companies. So really, it's tricky as professors and PhD students to be thinking about their financial future, just like everybody else. We really do have to think about that. And I actually just want you to be very wealthy. And hopefully, in 20 years, you'll come back. And if you watch this video, you'll be like, hey, thank you so much for doing this. And then maybe you can pay me back somehow in 20 years because you've done this. But I think personal finance is one of the easiest things that you could possibly do. It's also really one of the most difficult things I think most people really struggle with. And I just wanted to kind of walk you through this just based on, some basic things. I know a lot about personal finance. We've done okay as a family. And I also sort of study this kind of stuff and kind of have a sense of it. Studied, did a bunch of sort of finance courses in my PhD and my undergrad, economics, a bunch of stuff. I'm also an engineer. I'm pretty confident with what I'm saying here. And it's actually really easy to do, and that's the thing that I want you to focus on. The tricky part is actually doing it, and that's where people get messed up. So the best thing that you could possibly do is to save 15% of your total income and saving it in any way that you want. And at this point, if you don't feel comfortable doing mutual funds or anything like that, just put it in a bank account. That's the best thing that you could possibly do. And just hold it there and keep that, so that 15% of your income will gradually grow and turn into something wonderful. And that's what I want you to think about. But, if you want to gain a little bit of advantage from this, this is what I do. And we do okay. It just takes a long time. But, it's fast once it happens, but it seems like it takes a long time. So a long time being a couple of decades before it actually sort of pans out. I'm about 10 years into doing this at this point, and it's doing okay, but I still have a long time to go in terms of where we're going to be in this world in terms of building wealth and all that kind of stuff. So first thing, if you build off your if you have any debts at all, like school debts or anything like that, pay those off first. That's the best thing that you could do. I know that there's lots of sort of gurus out there that say to do that. It actually is a lot of truth behind it. There's lots of sort of behavioral finance behind, you're going to feel a lot better once you pay off those debts and you don't have that negative, you're not in the hole. It sort of changes your perspective in a lot of ways. So pay off those debts. It's the first thing that you could do. Live very modestly as much as you can. So my wife and I, we live off of one income. We've always done that. And, as PhD students, you probably know how to do that. Just continue to do that. Our lifestyle has not changed that much. However, in the last year, maybe 3 years, we have expanded our lifestyle a little bit more with going on vacations, going for like a 3-day thing someplace, those kind of things. It just takes a long time. And it might not be until you're 40, but that's okay. If you think about it, by the time you're 40, you still probably have about 50 years of your life to live very nicely after that, right? So just kind of have that mindset. So, there's two really good options that I would consider for you to buy in terms of mutual funds or investment sort of vehicles that do okay. And nothing else is really worth it, because there's lots of tricky sort of financy kind of stuff that it's a load of garbage, to be honest. We teach finance totally incorrect, or the public perception of finance in terms of picking stocks and stuff is totally incorrect. And some of the biggest finance gurus will tell you that to not do that. If you went to, you know, University of Chicago, they're basically, a lot of people are going to tell you don't pick stocks. So, you know, the first thing is the first sort of vehicle that you could buy is just index funds. And instead of doing that sort of savings account, just get index funds. And so what are index funds? Those are financial vehicles that you're buying stocks. You're buying all of the stocks that are traded on an index, a financial, one of these, the NASDAQ, for example, or sorry, on a stock exchange. So like NASDAQ, and you're just buying all of them, or you're buying all of the top 500 firms that are on a stock exchange, and usually that just means the largest companies in the world, or the fastest growing, sort of most valued companies in the world. And you just buy those, and that's pretty easy, and it's super easy to do. So what I do is use Vanguard, and there's one that's the VTI. I think it's a total index fund. VTI is a symbol. That's all I do. No reason other than Vanguard's been around the longest, and they really strongly believe in this. It has panned out for them. That one of the largest mutual fund companies or index fund companies at this point, because they've been around the longest. So they completely understand how to do this, and I trust it. That's an important thing, that trust. The second thing that you can do is to look for mutual funds that are broadly diversified and that are really old, really, in terms of the mutual funds that are out there. So what you could do is look for ones that are slightly beating the market, but you're not really beating the market. I think that's where people get mixed up. You can't beat the market. What you're looking for is they just have a slightly, they're a little more risky. And if you're in it for the long run, so you're in it for 20 years, that risk is actually good. You can accumulate a little bit more wealth from that. So looking for, good, broadly diversified, but also ones that are sort of, they're either high growth or growth mutual funds that are, that are well recognized, have been around for a long time. Those are going to be the best ones. So, for us, in terms of our family, we have mutual funds in like Fidelity. These are just some of the ones that we own. Fidelity, American funds. Those are the ones that I can, think about at this moment. But basically, they are old. They've been around for a long time, and the brand is less important than what you'd imagine, and you're just looking for ones that have been consistently doing okay, and matching the market, maybe doing a little better than the market, but you're bearing a little bit more risk when you're doing that. And you're also looking for, so if you're getting the mutual funds, it's good to get a advisor that's part of that package, and looking for somebody that's going to be helpful with the advisor. And really the reason why you want that is sometimes they do find things that are helpful, and they can kind of help you through. And you don't want to look for ones that are like salesy and scammy, but look for ones that are just helpful. And you just have to do this for, those two things, like the, either the mutual funds, broad-based mutual funds, or index funds. I probably recommend the index funds first. If you just do that for several decades, then you're going to do okay. You just keep investing that 15%, and you do that day in and day out, week in and week out. It's really, and that's where I said it's like super boring. But you just do that for a long time, and it does work out in your favor. You will build a pretty substantial amount of wealth simply by doing that. The last thing that you want to do is, especially, and this is probably more geared towards the professors and PhD students, but also those of you who are employed, is to leverage the opportunities that you have at your university. There is always financial advisors that are at your university, and see what they have and look at the resources they have. Don't look for the ones that are really salesy. I find that is that's a really strong sign that there's something going on. And I don't absolutely trust them. Advisors, I really don't, because they have a motivation to, to make more money off of you. So just be careful with that. But, just go into it looking for somebody that can be helpful. Here's some things that you don't want to invest in ever. Single technologies or stocks or single companies. I mean, these are going to be very risky. And when I hear students doing this at school, I'm biting my lip. And I try to tell them, don't do that. They're going to end up getting in trouble. Tesla is it's a cool company. I'm not going to invest in it completely. Walmart's a great company. I'm not going to ever invest in that completely. It's too risky. The stock market something weird can happen overnight, and you can lose a huge chunk of money. So try not to do that. And then, the other thing is, don't invest in your people that like students or friends and stuff like that, unless you're really thinking that this investing is really just charity. If somebody comes up to you and says that they have this great idea, unless you're viewing it as charity, it's really, you're going to lose your money for the most part. You just really are. So be very stingy with that, unless you're just like, I'm being very generous and it's a sort of charity thing and you want to give somebody like $5,000 on the thing that they're doing. That's it. It's really simple, and you should do very well by doing this. And it's going to take you a long time, though. That's where people get hung up. I just want you to do this for 2 decades. And after you've done it for 2 decades and I'm a little grayer, then come back and talk to me and say thank you. That's it. So, all right, take care and have a wonderful day. Bye. Give me one of these. Bye.